Right. Okay. So let's quickly get started in the meantime. So, like I was saying, the session also focuses on creating that awareness why women need to, get into the field of finance. And what better quote than this, which says that, the question isn't who's going to let me. It's basically who's going to stop me. So I just feel this is so powerful. I mean, women are creating a mark out there for themselves in various fields, but finance, I feel, is one area where there is still that hiccup which is existing. So that is what we are trying to address and tackle as well. In fact, there are some myths that women are not very good investors, or they are very risk averse. But if you have to put it out the other way, they are in fact they're more aware about the kind of risks that they are taking. They're known to be savers. They accept assistance when required. Of course, they do exercise their caution. So all of that ultimately ends up to making them powerful investors as well as traders. We have so many beautiful examples. We have Kamala Harris. We have Falguni Nair, the CEO of Nykaa. We have Nirmala Sitaraman, who's in India. She's doing a fabulous job. We have Christine Lagarde, who's heading the ECB, and then we have Kathy Wood as well. I'm sure you must have heard of ARC investments. So when women are in these fields, I'm sure when it comes to finances, also, I mean, these women are creating a wonderful mark for themselves in the field of finance. So why not women take charge of their finances? And just to understand why it is important for women to be financially independent, just to give you a brief now, according to stats, women are expected to live longer. They tend to live longer than men do. I mean, no. No offense out there, but this is just a fact that women tend to live longer. They of course, unfortunately, in many fields, I think barring airlines, women end up earning lesser. And of course, because they have less direct experience or exposure to financial planning, for all of these reasons, it's very important that women, take charge of their finances. Of course, many a times women also do have to, take a step back in their career due to maternity reasons, or if they want to take care of their family members, or so on and so forth. So they tend to even retire early. So all the more why it is necessary that women take charge of their finances, because they tend to live longer and they're earning lesser. So I think it's very, very important that we women take charge of our finances as well. Now, that's about it. Just getting on to the main presentation and getting started with how we can achieve this independence. And it's just not catering to men, I mean, to women. It's for both men and women as to how we can achieve this financial independence. So I've just listed a few tips out here. I mean, and we'll be discussing about each of these in detail. The first one is like just start now. It talks about a systematic investment plan. I'm sure you all have heard about SIPs. If not, we'll be discussing, and I'll be sharing some numbers that will throw lights. I mean, onto why it is important for you to stick to discipline. Then we'll be talking about what is the use of diversification and how it helps your portfolio. And most important is that while you're doing all of this, it's very important that you keep it simple. So we'll just discuss how can we go about all of this, and yeah. So now, when it comes to start now, before I get on to that, um, I mean, the reason why you need to start now is because of the compounding benefit. And I don't know if you all believe in this or not, but if you were to ask me if there were to be an eighth wonder in the world, I think definitely it should be compound interest. Now, I mean, on this slide, if you can just look at it, like this explains about $10,000, which was invested annually, and what happens if it compounds at the rate of 10% after 25 years. So that $10,000 would actually end up going up to $108,000 after 25 years. So if you look at it, the investment over here is just $10,000. The remaining 98,000 is coming without we doing anything. It's just that money is growing itself. It's a snowball effect, and that's the power of compounding. I mean, before I even get started and we get into all of this, just to give you another example. I mean, in fact, that was the reason why I decided to get into the field of finance. So how it started was, I mean, when I was a kid, no, I mean, not really a kid, but in my growing teens, when my dad asked me this question, and that is when I decided that, oh, this is really amazing, and I need to get into, my love for numbers was it just started growing from there on. I was always good with math, but this question just changed the ball game for me. So, and I would like to raise the same question to you all. In fact, it's a deal, and I would really like it if you are responsive enough and use your chats to respond. So the question, I mean, the deal was like that. It is a 31-day deal. So let's assume it's the month of May. Okay, we missed out on yesterday's thing, but it's okay. So for 31 days, the deal is just plain and simple. Starting today, you need to give me 50 fills. Next day, we need to double it to 1 dirham. Then we double it to 2 dirhams. Then we double it to 4 dirhams. Then we double it to 8 dirhams, and so on and so forth. We just need to do this for the month of May. Okay, I'll let go of yesterday. We start with, say, 1 dirham. And in return, I can give you, you can ask as to what are you expecting in return. You can use your chat boxes that how much do I need to pay you in return. At the end of 31 days, for you to do this, what are you expecting? How much do I need to pay you at the end of 31 days? It can be anything. It can be $10,000. It can be $100,000. So you can just say what are your expectations? How much should I pay you for this deal? Okay, we have someone saying that they are expecting $100,000 for this. Let's see. Let's make it more interactive. Come on, just use your chat box and just type it. What are your expectations? What would you demand for a deal like this? Okay, so let me tell you, the maximum that someone's told me that they would demand is $1 million. That is what I have been told. Now, I mean, that's a very big amount, $1 million for this deal. But let's do the math and let's understand as to how much this would end up going up to. So we start with 50 fills on day one. So today is second. So we'll be starting with 1 dirham. Then it's 2 dirhams. Then it's 4 dirhams. Then it's 8 dirhams. 16, 32, 64, 128, 256. I rounded off for convenience. It is just 250 dirhams on day 10. Then we have 500, 1,000, 2,000 dirhams, 4,000, 8,000, 16,000. Then we have 32,000, 64,000, 128,000, 256,000. Again, I rounded off to 250,000. Okay, so whoever asked for 100,000, you're definitely in loss on day 20 itself. This goes up to 500,000, 1 million. So the person who asked for 1 million is also now running into losses. We have 2 million, 4 million, 8 million, 16 million, 32 million, 64, 128, 256, and it's more than 500 million. So that's the power of compounding. Of course, there is no place in the world. I mean, nobody can guarantee you 100% returns in any given year. If someone is doing that, please don't invest with that person, because that's most likely a place where you'll be burning your money. But this was just his my dad's way of explaining to me the benefit of investing and the benefit of starting early, and what will happen in the long run if you keep accumulating your wealth at a certain percentage. So let's look at this. We have two females out here. One is Ria and one is Shreya. Ria starts investing at the age of 25, and Shreya starts investing at the age of 35. Both decide to invest $5,000 every year. Okay, so Shreya pushes forward her investment to 10 years, and she starts investing at the age of 35, whereas Ria starts at the age of 25 itself. Now, if you notice, the difference between the investments for these two is merely 50,000, right? Now, the difference is just 50,000. Let's look at what is the difference at the age of 65 in their wealth accumulation. Can anybody guess over here what would the difference be if the money grows at the rate of 10% per year? Can we have anyone putting up any numbers? Let's make this interactive. It's going to be fun for y'all as well and me as well. So let's try and understand the differences, and let's quickly understand how this will help you in the long run. I mean, it's really amazing once you get to see the impact of starting early. All right. So when you look at this, Ria at the age of 65 has 2.2 million. And on the other hand, Shreya has 822,000. Now, of course, this is also a significant amount. When you have 822,000, that's a significant amount. But when you compare it to what Ria has, that's like 2 million. I mean, the difference is 1.4 million, which is huge. So that's the benefit of starting early. Let's look at another example. So there are three friends over here. We've added another one, Priyanka, who starts at the age of 45. Now, this example is about someone investing $1,000 only per month, and they are doing that every month for until they reach 65 years of age. That's the age wherein we retire. So if someone starts at the age of 45, okay, and they invest, the investment amount would be to 40,000. Basically, you have $1,000 per month into 12 is 120,000. I mean $12,000, and into 20 years you'll get 240,000. Now, like I said, we are investing for 20 years. That's why 240,000. At the end of 65 years, if it grows at the rate of 10%, this amount would go up to almost 758,000. So that's huge, because you've got almost more than 500,000 that you are earning just by your money is making money for you. Now, when it comes to Shreya, who started at the age of 35, the investment amount is 360,000. So the difference between Priya and Shreya is just 120,000. But that 120,000 eventually will pay you more than 1.4 million extra. Like, this person is earning like 800,000, but Shreya over here is earning 2.2 million at the age of 65. So you see that 10 years is the effect has been significant. Now, if you look at Ria, who started at the age of 25, again, her investment is just 120,000 extra, but the amount at the age, I mean, of 65 is $6 million. So the difference between the investments is like almost 5 million. So it is huge when you understand the impact and the power of compounding and the benefits of starting early. Now, so for all of those, I'm sure many of you would be having the question that, okay, fine, this is amazing. I'd love to start early, but where do I invest? What would give you that kind of investment return? Should it just be in something that's very safe, or should I take some risk and invest in stock markets? All of that would be answered in the latter slides. But just to give you a basic example, just so that you have an idea and an understanding. Like I said, this is a very basic session that we are catering to the basics. So these are some of the brands that we use on a day-to-day basis. How many of you use Netflix? I'm sure we all binge watch. We've seen so many things on Netflix. How many of you love the brand LVMH? How many of you have an Instagram or Facebook account? Females over here, I'm sure we all love the Estee Lauder brand. How many of you love L'Oreal, or how many of you shop on Amazon? Um, then we have Microsoft. Almost everyone working must have come across Microsoft in their offices. So Starbucks, or for all those coffee lovers out there, these are products that we use on a day-to-day basis. We invest in them on a day-to-day basis. So why not invest in the company itself? I mean, why not become a stock owner of the company? So that ways you're ultimately, investing in the stock, and mm, benefiting from the same. Of course, you have to do some groundwork. You have to understand what's the returns that these companies are giving, what's the expected profitability in the years ahead. But these are some common names that we all understand. We all understand what business they are into. So investing in these companies is not that rocket science. So this is what we're trying to cater to, that make it simple, cater to things that are simple and where you can invest. Now, just to give another example, now, like we saw in the previous slide, we saw Ria, Shreya, and Priyanka investing $10,000 every month. Now, what they were doing was, it's called as a systematic approach, wherein you decide an amount you want to invest. It can be $500, it can be $1,000, or it can be $100. You decide what's the amount you want to invest every month. You fix that amount and you invest. Now, again, the question is, where do you invest? If you want to invest in markets, then a common benchmark that you can invest in the markets is the S&P 500 index. Now, this index is, like the name suggests, it's tracking the largest 500 companies in the United States. So when you invest in that one particular index, you're ultimately investing and covering a basket of securities. So your risk also minimizes. Of course, if US markets go down, your index and your portfolio value will also go down. But your risk is not limited to one particular company. One particular company can fail, but 500 companies at one point cannot fail. So that's why we focus on investing. Suppose if you invest in the S&P 500, what happens in that case? Okay, now before I proceed, I'd just like to say that none of this information over here that I'm saying during this entire presentation tells you to go and invest in the market, or in this particular instrument, or in this particular stock. We're not promising any of these returns. Where you should be investing, how you should be investing, it all depends on your risk profile. This is a very generic presentation, so it will cater to, for each individual. You need to understand your risk dynamics, your age, your investment goals, and accordingly decide and chart out a plan for yourselves. So that, having said that, I mean, these are some basic things, but please do not imply this as an investment advice. This is just general information that we are sharing out here. Okay, so this slide basically gives you an example of what would happen if you would have just invested $1,000 every month in the SPX 500. And when I look at this, I mean, these numbers are just amazing. And I wish, what I wish for is, I wish my parents had done this for me. So today I would have been like completely sorted. So when you look at this, all of these things really play out, and in the long run. So you start bearing the fruits in the long run. Now, the starting date of this is 1971. In fact, that's 50 years from now, more than 50 years. That's when UAE also came into picture. So that's why we've considered 1971. And these are just some basic examples that I have shared over here. So if you invest $1,000 in S&P 500 every month, so your total investment will be 628,000. And just look at that. As on today's date, one would have had $26 million in account. If you do not withdraw those investments and you keep investing, this includes your dividends as well. So that would grow up to $26 million as of today's date. And in dirhams, that's like, I mean, 98 million dirhams. So the amount is significant. Even if you invest in 1980, that would have grown to nine, almost $10 million. If you started in 88, I mean, that would have grown up to 3.3 million. Your investment is just 424,000. So the remaining 3 million is your profit. Isn't that huge? Like $3 million. That is like money is doing the work for you. We don't need to do that work. It's like money is growing itself. And I truly believe in this concept. I mean, in the kind of time, day and age that we are living in, wherein inflation is so high, we need to search for ways where money can, do the job for us rather than we constantly working for money. Then these are just the latest and the recent examples. Suppose if you would have invested at 1998, then 300,000 would have become 1 million. And then if you were invested in 2008, this is the kind of wealth you would have accumulated. So the numbers are just amazing. And it just signifies the benefits and the importance of investing regularly. And just to give you an average return for S&P 500 has been 10%. So the numbers that we saw on the previous slide also will give you a fair idea as to what happens if you would have invested in the long run. So in case if you want to know, like, what would the returns be if you invest in S&P 500 for the next 20 years at 10%, we can do that calculations and provide it to you. Whoever is interested can get in touch with their RM. Like, say if you want to invest $500 every month, or you want to invest $1,000 every month, and you're looking at what would the expected return, expected value be at the end of, say, 20 years. We can provide that calculation on the assumption that what has happened in the past will happen in the future. There's no such guarantee, but it's just taking us to a reflection of what has happened in the past. In the past, on an average, the S&P 500 has offered roughly 10% returns. So considering we see a repeat of that, what would be the expected returns in the future? So just to give you a rough ballpark idea. So that is something that we can do the calculation. Now, moving forward, so yeah, this basically gives you an example, or I mean, the advantages of the SIP method. Of course, I'm sure you all know by far that it is creating financial discipline. The biggest advantage, this is like the most important advantage of the SIP method, because when one is investing in the market, we all try and time the market. That there are so many people in the recently, whoever is tracking the markets, S&P 500, everybody thought that it's going to crash miserably. And in the meantime, I mean, the markets came down to even 3,500, 3,600 levels. And investors thought it's going to crash further, and nobody invested at those levels. And in fact, if someone would have today, S&P of course is falling again, but it went up to almost $4,200. So you would have made all 15% returns in a span of hardly, 2 3 months. So that's the benefit. I believe 4 5 months. So that's the benefit of sticking to an SIP method. You're not trying to time the markets, because what happens is that when you try to time the markets, you think that the markets are going to fall or the markets are going to rally, but that may not always be the case. And obviously, it's pocket friendly. We don't have to put in a big chunk every time. You just have to put in an amount that you are okay with. You don't need a lump sum investments. Of course, you can choose for a plan which requires a lump sum investment at certain intervals, and in between you have small investments. But the idea behind SIP is that every month you just put out a small amount. Then, of course, we've seen the compounding effect that S&P has provided in the previous slide itself. And yeah, because we are investing at regular intervals, what happens is that today SPX might be at 4,200, but tomorrow, when SPX is down, or yesterday, for example, when SPX was down 6 months prior at 3,600 levels, you would have got the advantage of that as well, because you're sticking to a fixed SIP method wherein you're investing a fixed amount every month. So that's the benefit of SIP. If anyone has any questions, you can raise your questions over here. If not, we'll move forward with the presentation. Just checking if there are any questions. All right. Okay, so no questions so far. Now, this slide just gives you an example as to what happens if, this talks about why it is important not to time the markets. So, the longer the one stays invested, the lower the probability of losing money. So, if you invest in, for SPX for only 1 year, there is a 27% chance that SPX may close lower in that year. If you invest for 2 years, that probability reduces to 19, so on and so forth. So ultimately, if you're investing for a 14-year horizon, your loss probability is zero. So in a 14-year period, there has been, like starting from whenever S&P was started, there has been no such 14-year period where SPX has lost money. So yeah, this slide just gives you that explanation. Now, like I said, there where to invest in. There are different baskets and different asset classes, and this slide will explain to you as to what are those different asset classes, and how can you decide which asset class to invest in. So there are different asset classes. We have, just like you have your wardrobe. So that ways you have these different asset classes from which you can choose to invest in. So we have fixed income. It's just like your savings account or your fixed deposits that you are aware of. Then we have equities. Equities are, like we've been saying, they are basically you're investing in the stock of a particular company, or you're investing in a basket of companies together. Those are called as indices. Now, if you believe in the future of that company, you basically invest in the share of that company, you become a shareholder, you become an owner of the company, and you share the profits. So, what happens in terms of equities is that in the event of a risk, or if the company shuts down, first all the debt holders will be paid out, first all the other liabilities will be paid out, and then whatever is left, the equity shareholders will be paid out. So, that is why equities are considered risky. But like we say, like we've seen, if you're investing in the largest 500 companies, the chances are very minimal. Of course, anything can happen, but we have seen in the past. But your the chances that all those 500 companies going bankrupt at the same time is very minimal. Of course, It can happen if the US economic crashes or something of that sort, but the probability of, I mean, that happening is very minimal. Then we have commodities. If you believe in gold, or if you believe in, if you want to invest in oil, if you want to invest in platinum, silver, there are many commodities. There are even agro commodities that you can invest in. People generally use agro commodities as a mere for, hedging. Of course, real estate is something I'm sure we are all aware of, wherein people are investing in the real estate markets. And then we have forex, wherein it talks about investing in a particular currency. So if you believe the dollar is going to get stronger, then you can invest in the dollar. If you believe the euro is going to get stronger, then you can invest in the euro. So this is how it is. These are the different asset classes, with fixed income being the safest. Um, and of course, the other asset classes are very volatile. Equities do have their own risk, but commodities in general are considered much more volatile because they are very seasonal in nature. So, yeah, uh, fixed income is the safest, and then the risk varies for all the other asset classes. Now, so how do you decide where to invest? How much to invest in fixed assets, or how much cash to keep aside, and how much to invest in stocks and other risky asset classes? How do you decide that? So that is something. This is something called as asset allocation. Of course, a common norm is that you always keep at least 6 months to 12 months of emergency savings, of emergency funds with you aside. So for 6 months, whatever you think your requirements are to survive on a day-to-day basis, that much cash you should have available. And that can be kept in your bank savings account, or something which is offering you some kind of return. If not, in any which ways, 6%, I mean, 6 months saving is something that should definitely be there before you start investing in the bond markets or into the stock markets. Now, when it comes to fixed income, the risk for fixed income securities is that when you invest in a fixed income bond of a particular company, if the company goes bankrupt, if the company defaults and does not pay you the money on the bond, then you lose that money. Okay. And as far as the stocks are concerned, the bondholders will always be paid prior to the stockholders. Okay, so bondholders have that advantage. But for the bondholders, the disadvantage is that you get only a fixed percentage in terms of coupon that you can make, during your tenure of investment. Whereas for stockholders, the gains can be unlimited. You get to participate in the profits of the company. So the company is doing well, the you are sharing those profits. So you get to participate in the profits in the longer term. So that's the difference between stocks and bonds. So now, how do you decide if you should be investing in bonds or you should be investing in stocks? Now, a general rule of thumb is that you do 100 minus your age. If you have, like, whatever your age is, you just minus 100, and that much you I mean, so let's understand. If someone is 35 years of age, so you have like 100 minus 35, so 65. 65% should be invested in equities, okay? And the remaining 35% can be invested in the bond market. So, okay, this is another slide which talks about what happens, the risk factors associated if someone would have invested only in one particular asset class. So, this is something you all can, look at later. But I would just like to talk more about asset allocation, like I was explaining. So suppose if someone is 20 years, so if you do 100 minus 20, 80% will go into stocks and 20% will go into bonds. If someone is in their 50s, 50% should be invested in stocks and 50% should be invested in bonds. The reason why we are doing this is as you grow older, um, the thing with stock markets is that I mean, when you invest in bonds, your money is secure. If you're especially if you're investing in government bonds or U.S. Treasury bonds, so there your money is safe and secure. So when you're investing in a government bond, your money is safe and secure. So when you are closer to retirement, at that time, you would not want to see that kind of volatility. Or when you are in, when you are in your 60s or in your 70s, that is the time when investors generally don't have their jobs. So when they don't have their jobs, at that time, they would not want to see that kind of volatility that is expected in the stock market. So, for example, we saw in the year 2020 or in the year 2008 when the stocks market, they literally crashed. But if someone would have waited, in fact, if someone would have invested in 2008, they would have minted money. So, the thing with stock market is that if you require funds immediately, um, you may or may not be lucky to withdraw at that point in time if your portfolio is down because the market is down in general. So for that reason, it is advisable that as you age, you need to invest your more proportion into bonds because they are generally considered much more safer. Now, these days, that 100 rule, that 100 minus your age, has in fact changed to 110 minus your age or 120 minus your age because one, the life expectancy has gone up. So previously, people used to stay for 60 years or, for 65 years, but now the average age expectancy has gone up to 70, 75 years. So considering that, you need much more money to help you survive your retirement years. And of course, it's a known fact that stock markets end up providing, they're of course riskier, but they end up providing more returns than the bond markets. And so there are many who these days recommend even 120 minus your age. So if you are in your 20s, ideally 100% should be invested in the stock market because you can afford to take that risk even if the markets go down. You have sustainable amount of time for the markets to recover, significant amount of time for the markets to recover, and for you to reap those benefits. So there's no risk, and you don't need those funds at that moment. So all of that needs to be kept in mind. So say if you're investing for your kids education and you need the funds in the next 2 years, so then investing in the markets can be a risky proportion because you need the money exactly in 2 years, and we don't exactly know where the markets would be in the next 2 years. But say if you require the money 10 years down the line, then in switching to an SIP program could make sense. So you need to analyze and you need to understand as to what is the right place for you to invest and where you should be investing. So all of those things have to be considered. Now, since we are on the topic, again, any questions, please raise your questions. Like I said, let's also try and make this interactive so that if you have any questions, in fact, let me also share with you that nobody else can see your questions. Whatever you're typing, only I can see them. So if you have any questions, please do ask. What would happen is that maybe someone else has the same doubt that you guys have, and you asking a question would actually help others um, solve their queries as well. So anything that is not clear or that I'm going fast, please let me know. Is the current pace fine? A thumbs up would really help out here. Am I being clear? Are you understanding what I'm talking? Um, okay, great. All right. So, yes, thank you. Okay, so, sorry, pardon me. Now, Let's understand why it is important. Since we are on the topic of diversification, so when you are investing in markets, or when you are investing, the one thing that you need to understand is that we need to diversify and invest across the globe. And the next few slides will explain to you as to why it is important to diversify your funds. I don't know how many of you are from India over here, or how many of you invest from India. Is if there is anyone, can you raise your hands or something, that, or just a thumbs up that yes, we invest in Indian markets. This slide basically it just gives an example as to what happens if you invest in emerging markets, and what happens if you invest in global markets. Since we in UAE, since we have many people from India as well, so we see many prefer to invest in their home country. Now the problem with that is that when you are investing in your home country, you are suffering from something called as a depreciation risk. That is, the country that you're investing in, that country, maybe your money is growing over there, okay, but the currency is weakening. Because the currency is weakening, your buying power is also reducing. So that is, one of the major disadvantages if you're investing in an emerging market currency. So that is something that you should keep in mind. Otherwise, when you're investing in um, global markets like the US markets or the European markets, the advantage is that you're investing in, across the globe. You're investing in companies who are the global leaders. For example, when you're investing in Apple, almost everyone loves using an iPhone. If you're investing in LVMH, it's a luxury that, that people across the globe love. So when you're investing in these companies, you're investing in global leaders. When you're investing in Microsoft, almost everywhere Microsoft is being used. So you're investing in global leaders, and that's the advantage of investing in the stock markets, especially the US and European markets. This slide just gives an example. I mean, if you just look at what I was talking about, like Nifty, which is the common benchmark index in the United States, that has offered 173% returns in the last, like, since 2008. Why we consider 2008? Because that was the year when markets crashed. So it's a benchmark here that can be considered. So since 2008, Nifty has given 173% returns, while SPX has given 175% returns. So the difference is not much. So you either invest in Nifty or you invest in SPX 500. The starting investment amount um, was 10 lakh, I mean, 1 million rupees in Indian currency terms. If I convert that to dollars, it would have been $25,000. So if someone has invested $25,000 in 2008, that would have gone up to 69,000, I mean, almost $70,000. But if someone, the same person who invested in India, that wealth, despite the same percentage return, that person would have got the benefit of only $33,000. So this difference that you see over here is the currency depreciation. So that's the benefit of investing in United States or in the dollar, because it is one of the reserve currencies, and it is the largest capital market, I mean, in the world. So not necessarily you need to invest in the US itself. You have other markets such as the European markets, you have UK, you have other markets as well. But we need to understand and analyze which markets are expected to do well in the future. You have China, you have Hong Kong, all of those markets are also available. So, depending on your risk appetite, the expected future of the company, that's how we need to plan our investments. Now, so like I said, going by the market capitalization, clearly the US is the superpower. So if the US fails, there's a great chance that it would lead to a recession. Everybody's talking about recession since. I mean, I've been hearing about recession since a very long time. It's not come. Of course, it's likely to come, but not necessarily a recession means a fall in the markets. we've clearly seen the markets have rallied significantly in the last 6 months. So, US is the major superpower, that's followed by Japan, then China, UK, France, and so on. Now, last but not the least, like I said, it's very important that we keep it simple, and this is a Peter Lynch method of investing, which talks about you invest in your core competencies, you invest in things that you understand. So the example that we saw in the previous slide, wherein you have companies like, I mean, Starbucks. So Starbucks is selling coffee. If you understand this business, it's easy for you to invest in this business. In fact, Peter Lynch had done an example wherein he asked kids, to invest in the markets, and those kids actually outperformed the well-known investors as well, because the kids invested in the stocks or in the companies that they were aware of and they used on a day-to-day basis. So yeah, if anybody is interested, you can go and read about Peter Lynch investing method. So that will talk about this example in detail. But all what he says is that first do your homework, invest for the long run, and invest in only what you understand. If you don't understand something, don't invest in it. Plain and simple. So invest in things you understand, and it's not like something else is offering amazing returns. I'm going to miss out on that opportunity. No, in the long run, um, if you invest in what you understand, that will pay you off. Because when you invest in something that you don't understand at all, even though it's giving you returns, but tomorrow, I mean, even if there's a crisis, you wouldn't know that you need to exit that stock and you need to sell that stock. So it's important that you keep it basic and you stick to things that you understand, or at least, if that's not the case, you hire someone, hire a consultant who can guide you as to, if he understands what he's doing, where he's investing, then fine. But you need someone who understands the business of that particular company. All right. So yes, that is it from my end. If you have any questions, any doubts that you all want, please ask those questions. So if not, we'll wrap up today's session. And yeah, before I wrap up today's session, I'd just like to say that tomorrow you'll have Vivian who will be talking about the technical analysis. Like today, I've spoken about investing and investing from a long term perspective. But there are people who like to invest in the markets on a day-to-day perspective, on a daily basis. Like you buy low, you sell at a high price, or and things like that. So, in fact, in stock markets, we even have the option to sell first and then buy later. So it's just a way that you can make money if you catch the high price, if you sell at a high and then buy again at a low price, or if you buy at the low price and sell at the high price. So how to read those charts, how to understand what is a good level to enter, what is a good level to exit, all of that will be covered in tomorrow's session by Mr. Vivian. And what are the different patterns that we have in the technical analysis in the financial world. So all of that will be covered, and it's going to be a great learning session. And then after that, you will have Yogesh as well as Vivian both together on the last day, and they'll actually help you with a live trading demo account wherein you get to understand and trade. And if you have any doubts, all of that would also be cleared. So, yes, I hope this was clear. If you have any doubts, any questions, please feel free to ask. Like I said, only I can see those questions. I hope you guys enjoyed today's session. Yes. Okay. Are mutual funds considered as fixed income or equity? What is the percentage recommend? Okay. Someone's asked if mutual funds are considered as fixed income or equity. Mutual funds are generally considered as equity investments. And they do have a certain percentage that might be invested in fixed asset classes as well. But most of them, it depends as to what kind of funds you are referring to. But in general, when you say mutual funds, it is generally referring to the equity. And what percentage is recommended, I'm not very clear. But like I said, when you say what percentage of your savings are recommended, then in that case, it would depend upon your investment goal. It would depend on your age. It would depend on the kind of risk that you're willing to take. If there are some people who are risk averse, who do not like taking risk at all, and there are some people who are okay with taking that kind of risk, whose heartbeat doesn't go up and down when they see their portfolio move up and down. So many things matter when we consider all of this. um, Okay, what happens if USD loses its status after the dollar, after BRICS initiate new currency? See, if the dollar will lose, I mean that is a long, long, long way to go for to for the dollar to lose its reserve currency status. Like China has been trying since a very long time. I mean, all of these agendas have been happening since decades, and if ever it has to happen, I mean, it will again take many more decades. So if that happens, definitely yes, we need to the dollar will lose its strength. Although there are other countries, China is asking others to trade oil in their currency, in the different currency. But all of that is a long, long way away. Even if that is happening, that's a very, very, very small percentage and is not having any impact on the dollar. So dollar is still the leading currency, and it would be decades away. These talks have been happening, but it would be decades away for something like this to happen. So if that happens, definitely that would call for a lot of risk, and things would change on various aspects. And that is one thing also that one should keep in mind. But currently that kind of risk is not foreseen in the near future. When I say near future, in the next 5-10 years also, we do not see any kind of, I mean, the dollar losing its safe haven status or the reserve currency status. We need to analyze though the impact that dollar would have on the fact that now the US government may start cutting rates once inflation comes under control. So those all things need to be analyzed, but this is not a major risk factor in the near term. I hope I've answered that question clearly. Any more questions? So, if we don't have any questions, then I mean, we'll end this session. I hope you guys enjoyed it and it was informational. Um, Please do share your feedback. It will help us improve in the longer run. And yes, if you like the session, please review us on Google as well. Thank you so much. This is, I mean, I am Deepa Sachanandani, and in case if you all have any more questions, if you want a one-on-one session, if you want to understand markets in greater detail, you can always reach out to your RMs and ask for me, Yogesh, Vivian, any one of us to connect with you all and provide you that session. We'll be happy to help. We love creating that awareness and creating that financial awareness as much as possible amongst all the investors or our clients, or for that matter anyone. So if any of you are interested, you can always get in touch with us. Okay, are there any REIT products? Sorry, I missed out that question previously. Are there any REIT products we can invest in US markets being non-US citizens? If so, please clarify. We do have REIT ETFs available on our platform, and even if you are a non-US citizen, you can invest in these products. So, yes, REIT ETFs are available, and you can, which those ETFs are basically tracking the movement of the REIT itself. So, it's not 100% investing in REITs, but we are tracking the movement of REIT ETFs. So, I mean, of REIT products. So, when you invest in REIT, you're investing in the REIT ETF, and that ways you can participate in the upside or the downside, whatever happens with the REIT itself. So, ETFs are known to track the exact movement of that particular product. So we do have that available on our platform. And even if you are a non-US citizen, you can invest in the same.